Multi-asset allocation funds. It appears that it is the current flavor of the season. We have a lot of questions from our subscribers and also general queries on whether you can use one multi-asset allocation for your entire asset allocation needs. After all, multi-asset allocation funds invest in equity, they invest in debt, they invest in gold, and in recent times they also use some derivatives to hedge. So it's an all-in-one fund, and the more important thing is that they are supposed to move across asset classes based on how the market is. For example, if you expect equity market to do very well, the fund is expected to increase, or if the equity market appears very inflated, you're supposed to decrease and move to probably other assets like gold or debt. So is it as simple as it seems? That's what we're going to look at in this video. Let's move on. So first, to understand what these funds do, they predominantly invest in equity, debt, and gold. Some use REITs to a small proportion. We don't have that many REITs in the Indian market. That is to give some real estate flavor. And many have in recent times started using derivatives. So this basically means that they most of them try to look like an equity fund. You cannot be sure that they are equity oriented funds because they have the flexibility to move more to debt as well. But most of them try to kind of invest up to 65% as a gross in equity and around 25% in debt and around 10 to 15% in gold. This equity part, many of them try to hedge. And when the market looks volatile, they actually increase the hedge to reduce the net equity component. What does this hedging do? It basically ensures that it reduces the volatility in equity, and it's kind of in the mutual funds under the mutual funds regulations, you're basically allowed to hedge your equity. You cannot go net selling into them, but if you already hold cash equity, you can hedge those. So that's what these funds try to do. Please remember, other categories of funds like balanced advantage and dynamic asset allocation, and then also your equity savings funds, obviously your arbitrage funds, all use hedging strategy. So I'm just have some data here just to give you an idea about the wide range of allocation that funds practice in this category. You can see that here some of the funds have as low as 43% or 44% in equity, others have as high as 75% in equity on a gross level, right? And some use very high hedging strategy. If you, for example, see this Edelweiss multi-asset, it has hedged almost its entire equity, right? And there are others who don't hedge at all right now. I mean, this is data as of August. You can see that Aditya Birla, Motilal Oswal, Nippon, they haven't really hedged. Instead, they've just have a higher component to gold and if necessary in debt, right? So the first point is that different fund houses follow different strategies of holding asset classes. So if the market is giving a unidirectional, kind of a signal, then everybody would be using the same signal to adjust their asset allocation, right? But they have not done so. So it is a very active call on where you think the market is headed. It is not so much about what you should be doing if A happens, B happens, but a fund manager's call on whether they should increase or decrease equity. So that's one thing that you should understand when it comes to asset allocation. The multi-asset is a call that each fund manager takes and it can keep varying. Some will get it right, some won't. Right now, let's just try to compare this because these funds use equity, they use debt, they use hedging strategies. I've tried to compare it with other hybrid categories. So if you look at other hybrid categories and this fund, this category of fund, you will clearly see that the deviation, that is the volatility component, is highest in hybrid aggressive. Naturally, because hybrid aggressive has very high component to equity, it does not invest in gold, it does not take derivatives, etc. Right? Then you see the second highest deviation actually happens in multi-asset. Now this is interesting, right? The reason is that as a multi-asset fund, you're supposed to take calls that either contain downside or capitalize on upside in different asset classes. Be that as it may, these funds because they are predominantly in equity, their volatility, their standard deviation, the way their price swings is not too far from hybrid aggressive. So that's one thing that you need to understand. These are not funds meant to contain downsides. Now look at the balanced advantage dynamic asset allocation. Their deviation is much lower. And then if you take equity savings, which hedges a lot more, it's lower. And I've taken hybrid conservative where debt is the predominant category, it's the least, right? So this is how they stack up in terms of risk and volatility. So it's closer to hybrid aggressive, which means it is closer to equity oriented funds in its risk and volatility. The second thing is that average returns. You will see that the average returns obviously of the hybrid aggressive is very high, and this fund scores next. There again, because majority of the funds, like I showed in the previous slide, have higher component to equity, they are able to deliver equity-like returns. But the deviation suggests that you need to hold them for the long term to be able to do this, right? The maximum returns again, the hybrid aggressive scores better. Please note that these are based on rolling 1 year returns rolled over, 3 years, which means total 4 years have been taken as the from and to point. The minimum returns, this is interesting. This fund obviously falls quite a bit over 1 year periods and it has fallen much more than categories like balanced advantage or dynamic asset allocation. So they are not meant to contain downsides. That's what this data tells you, whether it's volatility or the maximum hit that it has taken. They are not the highest in terms of yielding on the upside. In other words, your aggressive hybrid, a pure equity oriented fund with some debt, has actually managed to deliver better as a category. So that's something that you need to keep in mind when you think that this can be the only fund in your portfolio. Now, the next thing is we are also looking at longer term returns. I showed you rolling 1 year returns. Over the longer period, obviously, equity oriented hybrid aggressive fund score better, right? And please remember, actually, in this data, although this is point to point, it is interesting to note that over a 5 year period, your balanced advantage is actually done better than multi-asset. That's to do with the volatility, because balanced advantage is able to contain the volatility better. It has been able to deliver, but that's not true over 3 years. See, whenever equity does very well, your multi-asset will, because majority of them try to participate. But if you're looking at long-term returns, why would you go for it? Because your hybrid aggressive anyway gives you better returns and it gives you sufficient debt as well, right? So that's one argument. That doesn't mean I'm saying you put all your money in hybrid aggressive. We'll come to it a bit later, but this is what data tells you. If I'm holding for the long term, I'm looking at returns. I'm not looking at containing just downsides, right? And it appears that hybrid does a better job, and in some cases, even balanced advantage with lower volatility is able to do this job. Now the more important thing, many of us, don't want to mix funds. This is easy, a single fund to do it all. But I'm looking at it from a point of, cost. Let's suppose I take the regular plans. I'm not even taking the direct plans. I take the regular plans, which is what most people hold. Equity flexi cap, I've taken one of the higher cost categories. I've not taken a large cap. Its cost would have been lower. 2% expense ratio, corporate bond 0.55, gold 0.59. I'm doing a 65 25 10 in all of these. The blended expense ratio comes to about 1.5. The average expense ratio is close to 1.9 in multi-asset allocation. So even in terms of cost, it makes sense for you to blend. And please remember, when we blend, we are doing multiple things. And I'll tell you what those are. One, you're able to pick the equity fund that you want, as in the good performing funds. You don't have to necessarily stick to the equity in the multi-asset allocation. Two, you're able to do category allocation better. Your equity can have a mix of mid cap, large cap, or a multi cap, or you can simply have a mix of index funds, the Nifty and the Nifty 150 or the 500, right, at much lower cost than even this. So you have flexibility in the equity categories that you choose if you decide to do your own separate allocation. Similarly with debt. And please remember, in debt, there are multiple strategies for different time frames. If you're going with a shorter time frame, you have short duration fund. If you're going with longer time frame, you have corporate bond or gilt funds. So none of these choices can be made. In multi-asset allocation, it's hard to even pinpoint that X fund has this specific strategy in debt. They don't focus so much on that, right? They just try to keep a mix of high quality bonds as much as possible, or some gilts if necessary, depending on what the fund decides to have. There is not so much of a strategy in it. Similarly, in equity, fund can have large cap or may not, be more mid cap focused. It may or may not have a blend. All this flexibility is not available in a multi-asset allocation, and that's something that you have to be aware of. Apart from the fact that it's a lot more expensive, right? If you try to do a blending. Now, the important thing is, many of you, when you ask us about multi-asset, you say a single fund to hold it all, and based on market condition, the fund will move to different asset classes. Should that be your approach at all for multi-asset allocation or for your own asset allocation, right? What should be your approach? In our view, your approach should be that your asset allocation should be based on your time frame, your risk, and your goal, right? It is not the fund manager who can decide what your risk appetite, what your debt equity allocation should be. For example, if you have a 3-year time frame and a specific fund that I showed you has 70-75% equity, that's exceedingly high. You take a lot of risk, and there is a possibility that you can have negative returns, right? So what the fund manager does and what the market does may not be entirely in sync with your own requirement, because your time frame and your risk varies. For this fundamental and primary reason, we think that you should have separate asset allocation. Like I said, to summarize, separate asset allocation will help build a portfolio based on your own needs, your time frame, your risk. Separate asset allocation will help you choose the right funds, the good funds from each category. Separate asset allocation will help choose different categories. You can build, the risk and blend them quite well with multiple funds. And very importantly, even cost-wise, it makes sense for you to kind of have this separate split. So when do you use multi-asset allocation? I mean, you can view multi-asset allocation funds like a typical hybrid fund. You already have a hybrid aggressive as part of your equity oriented portfolio. You can possibly add multi-asset allocation. But there again, that cannot be your primary fund. It will not help you achieve asset allocation. That's the primary point that we are trying to make. So the next time when you're trying to, kind of build a portfolio, use our own, build your own portfolio tool, where you will be able to blend a lot of funds across categories and across asset classes to have an optimal portfolio.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.